Okay, well, it's a little bit past 10, so why don't we get going? And I'm sure we'll get a number of more people signing in as we go. But my name is Greg Kim. Thank you so much for joining us for our fifth webinar in our Restart Hawaii webinar series. And we're very fortunate to have Daniel Lamb, attorney with Goodson Anderson, with us to discuss how to get money. And so we're with Business Law Corps. I'm the co-founder, along with Kat Taschner, who's also online, of Business Law Corps. And she'll talk about what we do in a little bit. I know some of you have already been on the webinars, and so it might be a little bit of a repeat. We'll try to freshen it up each time for you. Kat will come up with something else to say, I'm sure. Let me just go over a few preliminaries, if I may. The series is really a labor of love for attorneys in the business area in Hawaii who want to really help small business get going. And we got an amazing response when we reached out to the lawyers to say, yes, we want to help. And so, you know, lawyers can really help the community. And so the series has been designed to address a lot of the issues that you have when you start a business. And the hope is that it'll push you along so that you can either do it yourself or accomplish a lot without having to use a lawyer or reduce your legal fees when you do. And so the series is on our Eventbrite. The next one is coming up. We have it pretty much every week. The next one is on April 8th, which is how to avoid taxes. And so that's being given by Chris Mashiba at the Cade Schutte firm. So please sign up for more. It helps us if you sign up, even though you might still get our email. I'm not sure you get the email if you're not signed up for the particular webinar. So if you sign up for them, for sure, you'll get the email invitation, and also we'll know about how many people are coming. By the way, this is being recorded. We're planning to publish the recordings as well as the manual of chapters that each speaker is writing after April, when the webinar series is done. And so we're not going to publish it until after that, and it might take us a little while in the editing process. So it might be a month or two after that. So perhaps in the summer sometime, we'll record all of the webinars and materials. We're adding a webinar, by the way, and you'll see it when we post it, I hope, that there's a gap in our series, if I may show you real quick. This is the series of webinars, and you'll see that we're on April 1st, April Fool's Day. And there's April 8th, there's April 15th, which is Get Workers, it's employment law. And then there's a gap because our last speaker had a conflict on the 22nd. We're gonna add a webinar on Thursday, April 22nd, which is gonna be the Richardson School of Law. I teach a class there, and we're gonna give an overview of all of the topics. And so if you want a refresher or you missed a webinar, it might be a good one for you to attend. So I will be posting that and then adding that as an event in Eventbrite. So hopefully you'll get that alert. And I think with that, I'm going to turn it over to Kat to say a few words about Business Law Corps and what we do. Kat?
Sure. Thanks, Greg. Good morning, everybody. Thank you for attending our webinar series. My name is Kat Taschner. I'm one of the co-founders, together with Greg, of the Business Law Corps. We are a nonprofit organization that provides free legal services to small businesses and entrepreneurs. So please keep us in mind as you think about starting your business, or even as you grow your business. Some of the services that we offer are seminars, like the one you're attending today. We also do free 30-minute legal appointments. So if after this seminar, you're like, oh man, I have a couple questions, I really want to ask specifically about my business, you can sign up for a free 30-minute legal consultation. We have 4 available every Wednesday from 11 to 1 p.m. And I'll drop the sign up information into the chat box so that you can sign up for the appointments. We also do direct legal services. And you can apply through our website. And so again, I'll drop that into the chat box, businesslawcorps.org. So thanks again for attending today. If you have any questions throughout the presentation, please feel free to drop them into the chat box. I'll be moderating them. You can also shoot me a DM, and I'll kind of aggregate them, and then we'll post them to Daniel at the end of the presentation. So thanks again for attending today.
Thanks, Kat. Just to add to what Kat was saying, as far as Business Law Corps, we've been around for 10 years, and we're kind of rethinking our model. So I think these webinars are going to be a thing of the future, more digital content, more education online. And so stay tuned for that. Let's turn to Daniel. So Daniel, I'm going to post his bio in the chat, and you can read it for yourself. It's quite impressive and long, and I won't read it, but he's a corporate attorney, which involves a lot of different things, but it includes helping businesses start and get financed, get sold, do contracts. So the full gamut when you're a corporate lawyer is what you do, whatever the client needs on the business side. And so Daniel worked on the mainland. Trying to remember what firm he was with. It was a big firm on the. He can say a few words about himself when he comes on. But graduate Punahou School, Gonzaga, and Creighton for law school, magna cum laude. So he's got a very impressive background, and as you can see from his bio, he's done a lot of deals. So, but he's got a kind heart. He's very active with BLC, always willing to help, and so I really like that kind of person. That's a sort of double bottom line kind of approach. And so if you want to meet with Daniel, by the way, he's on our attorney rotation, which Kat mentioned, and you can actually select him if you want to pick the date and times that he's actually giving those consultations. And so that'd be a good way to meet with him. Everyone needs money, right? I mean, we all have various degrees of wanting money, but when you're a small business, sometimes capital makes a difference, oftentimes. And so as corporate attorneys, we often caution clients about doing that. It's a very risky kind of thing to do, but we're trying to focus today on how can you actually do it. There are complex laws that you need to be familiar with, which Daniel will go over, but there's ways to be compliant for small business and high growth companies. So he'll kind of give you the lay of the land there. And ultimately, when you actually pull the trigger and want to take money from someone, you might want to call Daniel or your corporate attorney of choice. But at least you'll kind of be in the right ballpark when you do, and the lawyer won't have to kind of undo everything you've done. So that's the hope. And without further ado, I'll turn over to Daniel to talk about that, and then we'll leave it at the end for some questions, 15, 20 minutes. And Daniel was kind enough to agree to stay online for a few minutes after the webinar for anyone that has additional questions. So Daniel, I will turn it over to you.
Okay, thanks Greg, Kat, everybody at BLC for having me. Like Greg said, today we're here just to learn about how to get funded, how to raise money. I know this is the 5th chapter, so hopefully until now, you learned some other, good things about getting a business up and running. And, originally this started, I think, as a Restart Hawaii because of the economy and the coronavirus and all that. But, I think it's kind of, gone above that. And, based on, I think, the attendees, we have, people in the small business community, but also, the startup community. So I think today it'll be really high level. There's a lot of material, a lot of information that, you can see in the written materials, but, try and touch on a bunch of topics on really about capitalization, how to get funded, some sources, the process, and some securities laws to think about. So without kind of spending too much time on that, let's get through here.
I forgot to say that Daniel prepared some wonderful materials, a chapter as well as annotated forms, and I'll be providing those about halfway through to make sure that we've got everyone signed on. And he'll be mentioning his materials as he goes through his presentation. So.
Okay, can everybody see the screen? Good, okay. All right, so So the first thing, we're going to talk about a bunch of different, I guess, financing sources. But, the two main ones I think we all know are equity and debt. I think we've all heard of that. And, just to give a recap, right, equity, I think generally is just, in exchange of ownership for, cash or capital or other property in a company. I think that's the core. We'll go through a little bit more on the differences, advantages, disadvantages, but, basically that's what equity is. Debt, right? Kind of the borrowing of money from an investor or lender, basically with a promise to make, repayment of principal and interest over time. So those are basically, the two general definitions. We'll talk a little bit more about that. Other types of financings, as you'll see, there's hybrids, right? There's convertible loans, there's traditional loans, there's royalty financing, there's government grants, crowdfunding, crowdsourcing. So there are a bunch of different types of financing, I think, but a lot of times the two main ones people think about are equity and debt. So I think, when you think about starting a company, and again, these are for new companies, early stage companies primarily. Obviously, the first thing comes to mind is, the owner, the founder, you're going to bootstrap it, right? You're going to put in your own capital. I think that's simple enough to understand. But, just like everything, when you're doing, you want to just properly document that. So kind of talk about that later. But, when you have the articles of organization, if you're LLC, or articles of incorporation, if you're a corporation, right? You want to make sure the documents look okay. If you're a corporation, the authorized shares, the capital, the operating agreement, normally it's based on a membership percentage or units. But I think just the takeaway there is even when you're just starting out, you want to get the corporate formality set up. And I think a prior topic goes over just setting up an entity. And then if you are contributing capital, you want to document that, right? You have a separate bank account for that, for the company. You kind of keep track of all your capital contributions. Ideally, if you have a corporation or any LLC, you're, documenting at least, who owns what stock, and you're kind of keeping track of that. I mean, that's kind of a separate conversation, but in general, I think it's just keeping good records, because that comes up later. Say you get financing later from family and friends or these other investors, or you might be fortunate enough to get looked at for a deal or get acquired. They're gonna the parties you're dealing with are gonna want to look at your books. They want to do due diligence. So I think the cleaner your records are, just the better position you're in, just to deal with other parties that maybe more sophisticated and used to dealing with those types of entities. So something to keep in mind there. Other sources, of course, family and friends. Family and friends typically you have a pre-existing relationship with, so they're maybe not as concerned with just focused on maximizing the returns as a pure investment, because they might generally want to support whatever venture you have going on. Now, obviously, one consideration there is family and friends. Once you involve money, relationships can change also. So I think you want to keep that in mind just from a practical standpoint when you're kind of going to family and friends for money. And we'll talk later about kind of going out there and finding on just the manner of offering. But right now we're just trying to identify a few kind of common sources, I'd say. The next, we have some angel investors, other investors. So those I think are, you could lump private equity, venture capital into that group too. I think it's just third party private investors. But I think for this stage and for the types of companies I think that are mostly on this call, probably dealing with angel investors and friends of friends, or kind of referrals or professional connections, those types of investors. And I think just so some of you that may not know, angel investing or angel investors, you might have heard the term. It's just either individuals or groups or a bunch of people grouped together that are really interested in making investments into typically early stage private companies. So a lot of locations and places have angel investor groups and different organizations. Here, one example is the Hawaii Angels. You might have heard of them. I think they meet every month or every 2 months or so, and they hear pitches from different investors. And again, a lot of these are more for early stage or high growth tech companies. But Hawaii, I think, is a unique market where the investment appetite is more on the asset class. I think on just some people want to invest in private equity, private investments, where they may not be as concerned with the type of industry or sector or the type of company that they'd be investing in. Some of the financing structures that I think you are most common for these types of early stage financings, right? I have them listed out here: equity financing, private loans, convertible loans, SAVES, crowdfunding, crowd lending, royalty financing. Those are not as common, but I think we can talk a little bit about those so you are familiar with them. The big one, equity financing there. Again, the simple structure is if you have a company and you're offering 20% for X amount of dollars, basically you're exchanging part ownership in that company for that amount. That's, I think, in concept it's really simple, but there's a lot that kind of goes into that. Really, if you're sophisticated or you have an investor that's sophisticated, they might talk to you about investor rights types of, they want a board seat, they want certain distributions, they want certain veto rights, right? They want to be able to kind of get involved in the management, possibly. Other investors, they might be purely passive investors, where they're happy to just, hey, cut you a check, hopefully you make it big, but they're not really going to be getting involved, right? I think as a company, most people try and find more passive investors because they may or may not just be interested in the capital. But then again, sometimes companies, what they need, is not only money, but they need strategic advice, right? So that's sometimes the investor that a company might be looking for is someone that might be willing to, or that would get involved more, right, with either a strategy or maybe sit on the board or just help with synergies and that sort of thing. So I think knowing your investor is definitely important there. And obviously, documenting the transaction and going through all the terms. We'll talk a little bit about the process later. But one thing I think to point out in just the equity financing discussion here is capitalization considerations. I think, what I mean by that is, in a corporation, let's start with that, there are a designated amount of authorized shares. So if you have a corporation, when you file in Hawaii anyway, articles of incorporation, you're going to designate how many shares the corporation's authorized to issue. So if you start with, a lot of startups, high growth startup companies start with maybe 10 million shares. But if you're a local business in Hawaii, just forming an article, setting it up, a corporation, maybe you start with 1,000 shares, and most of the time, the owner will issue him or herself 1,000 shares. So right there, 100% of the shares are outstanding and issued. However, if another investor wants to now buy into the company, there are no more shares really to issue out to that investor, right? So I think the first thing is, before you entertaining any types of offers or talking about that, to kind of know your own capitalization structure. It's not, I don't want to say it's fatal to any type of investment transaction, because let's say in that situation there's no more authorized shares, the company can always just amend the articles to increase the amount of authorized shares, basically. But I think you want to just be conscious of that. And the other, I guess, alternative is, if all the shares are issued on outstanding, the owner can sell the purchaser some of his or her own shares, right? Out of the 1,000 that's already been issued to the owner can then resell that amount to the investor. There are some securities considerations also that can maybe touch upon with regards to resales, but that's something you can do. But if you're an investor, on the other side, you might, enforceability and knowing that what you have is it's paid in capital and it's good shares. A lot of times you want the shares issued directly from the company, right? Because you don't know if the if the current owner pledged his shares as collateral, sold it to somebody else. I mean, it's the longer you go down the line, the more uncertainty is on basically capitalization. So which is why, going back to keeping good records and all that, but also as an investor, that's some of the due diligence that might facilitate that process, the better records you keep. One more thing on the difference between purchasing the stock from the company versus the current owner is that if you're the investor, you may want your investment dollars to go into the working capital of the company, right? So if you buy the stock from the company, then you're contributing that cash, right, into the company. But technically, if you're buying the stock from the shareholder, the shareholder is getting that money, right? So I think that's, maybe that's the plan or maybe that's not the plan, but again, that's just something to talk through with during the negotiations prior to any type of equity financing deal. Real quick about LLCs, right? They're different. They're a creature of contract, whereas corporations are defaulted to the statutes really are controlling. LLCs typically are they're pass-through entities, disregarded from income tax level if they're single member. But regardless of that, just the capitalization is different, where on the articles of organization, the document you file to form the company, you're not designating an amount of authorized shares like you do for a corporation. They're members, they're managers, and again, LLCs are really governed by their operating agreement, and the statutes default to this concept of a membership interest, membership percentage. So it starts at let's say 100%. Most companies, most small businesses that use LLCs, have this structure by default. The other way is you have units, kind of like how corporations have shares, but that's just designated through the operating agreement. Some companies they'll actually authorize an amount of units that is the max units that can be issued without amending the operating agreement. So they bring in those corporation concepts into that, and sometimes you'll see that when the LLC's issuing stock, LLC's raising capital. LLCs sometimes will use that structure because it's easier to keep track of investors and different units and preferences, that sort of thing. But the takeaway there for a small business is, it's all based on the operating agreement. So that's really important if you have multi-member LLC and you don't have one. So when an investor comes in, you're going to need to do one of those. And about getting the investor, I think the interest is another thing to think about, because like I said, because of the breakdown of ownership percentages, how an LLC usually does it, usually or often you'll see when an investor wants to invest into an LLC, in that scenario where let's say it's owned by one person that has 100% of the LLC. In that corporation example, the corporation issued more stock, but the investor could have bought the stock from the shareholder as well. In an LLC, you might see more of the times the investor would purchase a percentage of the interest from the owner, right? So if the owner has 100%, maybe the agreement to invest, it's a purchase agreement where the investor is purchasing 20% directly from the current owner. So that's one of the forms that I think will be provided to you. So that's just the reason why that's a membership interest purchase agreement, and for the corporation we use the subscription agreement. Real quick, so that was the equity structure, typical straightforward equity financing. Private loan, on the other side, right, is private debt transaction, where instead of getting an ownership of a company, an investor might just be willing or want to invest money, but instead get back a promissory note, just like how a bank would do that. And then now the investor is technically, almost equivalent of as a lender, where now you're making payments usually every month or quarterly or annually, basically negotiated with the investor. So, if it's a friend or family, hopefully it's on good terms, but then, maybe not, because if it's a loan, that's really the only benefit the investor is getting. Other than if it's equity, there's, upside later. So, there's a trade-off. So typically if you see a loan, you're going to see, a lender really looking to get a return on their investment there. So we'll talk later about the differences in short-term, long-term considerations between the two. But I think, obviously the one thing to consider is with the loan, you're making periodic payments, so it's affecting cash flow a little bit, right? Whereas equity financing, you invest in a company, typically there's no right to make, or there's no right that the investor has to get distributions from the company. I mean, sometimes sophisticated investors will negotiate that right, negotiate that right in a shareholder agreement or something like that, where, each year or every quarterly or whatever, companies have to distribute out available cash. But usually what you'll see is, nothing requiring a company to do that, meaning there aren't really short-term, implications for a company that has equity investors, because there aren't those periodic payments that have to go out. But on a loan, that would be different, although the upside is maintained with the company in a loan situation, because the debtor or the lender has basically a fixed right to receive payments for the life of the loan. But if the company was sold or has an IPO or something like that, they wouldn't, receive any multiple or any upside on that investment. One more thing, one critical difference is if the company doesn't do so well, right? A lender has status as a creditor of the company, meaning, if the assets are sold or liquidated and, the note was not paid off, then the lender, would have priority over payments ahead of any of the equity owners. So that's one thing to consider as well. That kind of segues into the convertible loan. That, from its name, it's a hybrid basically of equity and debt. I think it's the form itself. It looks like a promissory note, looks like a loan, but just there's certain triggering events where the investor can convert it into equity. Whether it's an acquisition, a merger, IPO, or another financing, let's say by another investor, or group of investors. You'll typically see this in a early stage company that doesn't want to go through the effort of negotiating a big equity round, because that can get pricey and lead to costs. So it's almost used in a bridge situation or early stage, where you get financing and the investors are really just deferring, negotiating their rights to the next equity round, when you'll have another group of maybe investors investing in preferred stock, let's say, coming in. Then the convertible note holder, would get to basically piggyback off of that, and also still have their rights as a debtor in case it doesn't work out. They'll still get, basically they'll still be entitled to interest and principal payments. But if that's in practice, if it gets to that point, there's probably not a lot of money if the notes don't convert. But I think it's something still good to have. And one more difference, I think, between a private promissory note and a convertible note are the interest payments. In a convertible note, normally just accrue to the principal, to the outstanding balance. So although there's a debt component to the convertible note, it's not as restrictive on the company's cash flow as a regular promissory note that generally requires principal and interest payments, because everything just basically accrues on the convertible loan into more convertible stock. But if it doesn't convert and you reach the maturity, then just like another lender, you can call that. We'll kind of move through here. Saves, crowdfunding, crowd lending, royalty financing. I think you can read a little bit about that in the materials, but basically saves are like convertible notes, but just without the debt part of it. So for companies, they're really friendly because if the company doesn't work out, then you don't owe any investor like you would on a convertible note. But if there are those triggering events where the investment would convert into equity. Crowdfunding, crowd lending, that you might have heard about that just through the internet or whatever. But that's when you kind of go out to these SEC registered portals and platforms and raise money, usually on a smaller scale from a bunch of diverse individuals and that you may or may not have a pre-existing relationship with. And royalty financing, again, you might have heard about this a little bit. It's just basically investing into revenue streams. So it's kind of a hybrid also of debt and equity, but well, actually it's not equity, but it could be characterized as debt. So you're investing money and, for example, you'll get a profit share of net or gross revenue or X percent of every unit sold on something, right? Until in perpetuity, or if there's a cap on that, that's negotiated as well. But investors like this also because it's instant returns for them, right? Other than an equity financing where you have to really wait until an exit event to get your money back from the investment. Royalty financings, you start to see returns right away. Basically, if you base it off of monthly, weekly, quarterly type numbers. Sorry. Just on options and sources, right? So accelerators, government-backed loans, government grants, traditional bank loans, credit cards, crowdsourcing. So these are just other ways, other places you can maybe find money as investors, right? Accelerators, organizations that have cohorts for defined periods of time that really provide resources and mentorship and other advice to companies, usually in the high growth area, but it depends on what type of accelerator. So there are some here in Hawaii. There's Blue Startups. There's Mana Up, which is consumer packageable goods, right? So I think there, if you're just at what types of accelerators out there, and if you're in a company in that space that you could qualify, that's not a bad idea to check it out. A lot of times they'll invest money sometimes for some small equity, or at least they're connected to a lot of people in the industry. So that might be something good. Government-backed loans and grants, really just you get more favorable terms. I think the takeaway there is just favorable terms on funds because they're backed by the government. And in the written materials, I list a whole bunch there that you can go check out. But you've all heard of SBA loans. That includes there's the PPP, there's the EIDL loans now for the coronavirus. There's some state loans, back loans, grants. So I think as a small business, you just want to really put through the effort, just to kind of go through those and look for them, because as we'll talk later on debt versus equity, you do sacrifice management control and that sort of thing when using equity. So sometimes people and companies look through these other sources first to try and see what works best for them, and then kind of fall back on some other ones if you're not able to qualify or you're not eligible for some of these loans here. And then traditional bank loans, I think we're all aware kind of these, but generally, the loan qualification processes, can be lengthy. There's going to be collateral you got to put up, right? So compared to the promissory notes and convertible loans I was talking about, those traditionally aren't secured loans, right? Meaning there's no collateral security normally pledged for those, right? So if there's a default, the company's still on the hook, but but there's no, I guess, secured creditor right to, property that's pledged as collateral there. So there's a key difference, I think, there. Banks always are going to come in with a heavy hand. If you have a house, they're going to want mortgage the house. As a owner-run company, you're probably gonna have to personally guarantee the loan, right? And so those are just things to consider. Rates may not be as good, and I think, and also I think one critical thing to remember is that although debt financing as a bank loan would be, you don't really think about that being something that's going to take away management abilities of your company, because like I said, as an equity financing deal, you might give up ownership, you might give up percent of management from time to time, but on debt normally it's just a creditor debtor relationship. But through the loan agreements, a lot of bank or debt agreements, especially traditional bank loans, there might be a lot of covenants and restrictions and things you got to comply with and do and not do under the terms of the loan. So that's something to look at when you're going to enter into one of those transactions, because it may or may not affect the way that you operate. For example, the bank, you might not be able to make certain distributions to yourself. You may not be able to enter into certain transactions. You might have to keep a certain debt to equity ratio. So those sort of things I think you want to just be aware of. Credit cards, again, we all know about these, but I think these can be looked at probably practically as more bridge financing options if maybe you have other options lined up and you have to use some sort of bridge financing source until then. Otherwise, the high interest rates themselves, I think, make them not the most attractive financing options. Crowdsourcing, different than the crowdfunding and crowd lending, where they're basically micro private loans or private investments. The crowdsourcing is something more like donations from a wide variety of people online. So there's no securities being actually issued, right? Securities we'll talk about briefly later. Are like stocks and promissory notes, and when you're investing with the expectation of profits based on a business or common enterprise based on the efforts of others, right? That's a traditional security that would require compliance with securities laws. But crowdsourcing, you're not really investing anything expecting to make a profit, right? You're literally just donating to someone's cause. Like think of Kickstarter, right? You're going to donate to someone's company to get started. But then normally in those, they're going to give you like a product, right? Or going to give you a gift. They call it a gift. But you're not expecting that to make a profit or you're not going to invest in that. So there's really no security being issued there. So you think about it just as donations. And for companies, actually, this is a really good way because you're not giving anything up. And if they're almost like pre-sales, because you're getting a bunch of money from people and you're going to give gifts, but they're the product that you're trying to really fund anyway. So it's almost like, basically getting pre-orders on these things. And then you get all the, just the momentum from just through the market and all that. So, it could be something to look at.
Hey, Daniel, sorry to interrupt.
Yeah.
We're almost out of time
Okay.
before we start the Q&A. So I don't know if you want to kind of hit some of the high points for the rest of your slides or.
Yeah. Okay, maybe just, real quick, I'll just talk about, give me 5 more minutes about this. Okay. So equity compensation, just want to make one point about this. It's not really capital raising, but as we all know, human capital is a lot of times the most expensive thing for a company. So a lot of companies, a good tool, you can have equity incentives, equity compensation, right? You think of stock options, restricted stock, that sort of thing. And that by using those kind of techniques, you can, save cash and make more cash available for investments into the growth of the company, and also get key employees really on board and get some skin in the game also. So this could be, a good tool. And then there's a lot of things to think about: management, kind of considerations and control and all that. But I think there's a lot of ways that you can structure this where it makes sense for all the parties involved. So one thing I wanted to mention about finding investors, how we kind of went through some of these places you can find money, is just a manner of doing so, right? So in about, I'll talk for about a minute or two on securities laws, but I think the types of companies we have here when you're going out and seeking investments, you don't want to go out and generally solicit. I think that's the key, right? You don't want to go out and blast on social media, blast it anywhere, send email chains, just looking for money, because a lot of the securities registration exemptions, hinge on the fact that there's been no general solicitation of the public, right? Because you're kind of worried about that information getting down the street to maybe grandma or someone that can't really fend for themselves, and then now you have an issue because you're maybe defrauding investors. But that's so I think that's one thing. I mean, that's not saying you can't go out and do that, but there's certain ways you have to do that, certain requirements. So I think that's just something to just keep in mind. Just issue spot that. There's you can look through the slides and the info on the securities exemptions, but I think the takeaway there are each security, all the stocks, all the bonds, all the debt, the notes that you issue, they're technically securities where, the general rules, you have to register all that with the SEC and at state law or with state agencies. Many of the times for companies like yourselves, there's exemptions. There's a whole bunch here, but I think you want to just be careful on this manner of offering and making sure you're complying with all of these. Some typical ones you'll see are the intrastate offering exemption, where all the offers and sales are made within a certain state. That's a federal exemption. Certain limited offerings up to 5 million or 10 million on under a federal exemption. There's some resale exemptions, private offering exemption. That's one you'll see a lot, right? Like you can use that if you want to just sell to like a family and friend, right? Like if you have a pre-existing relationship, you haven't found the investor through generally soliciting or advertising. This is usually the exemption that you kind of back into. There are a lot of these safe harbors. You see that word used a lot. That just means if you comply with those extra requirements, you can have certainty that the offering is exempt. Although even if you don't meet those safe harbor conditions, it's possible it's a fact-based kind of a decision at that point, and you can still be found to have like an exempt offering off these other things here. Last thing I think about just the securities laws are that there's two things you have to be worried about as a company, right? If there's an offering exemption, that's the first thing. And then second thing is, even if you have an exemption, you are not prevented from being subject to some sort of securities law fraud or securities fraud lawsuit, which is usually what happens, right? Like an investor feels like they were wrong, and then they'll sue for both securities fraud and also an unregistered offering that was not exempt. So that's normally how they come up, but the consequences can be huge. And the one tip I think I'll say on the securities fraud thing is, be careful what you are saying and disclosing and providing to potential investors during the offering. You don't want to promise any returns. You don't want to, you want to use a lot of kind of, if or we think, or that types of forward-looking cautionary language. And if possible, use the term sheet, use the business summary, or there's a private placement memorandum that it's kind of like a business summary that just you get all basically the risks, and you just disclose everything you want to disclose in writing, and then look to that when you have the investor say, okay, all I'm basing my investment decision on is this right here. So there's no kind of really back and forth, or he said, she said on what you did or did not say during that. So I I think that's I think the takeaway there is just, you know, the anti-fraud kind of concerns, and also just finding the right offering exemption. And you know, we didn't really get to talk about preparing for the investment, but again, you know, just I think these are the 5 I think key things like you can kind of think about here. So after you find possible investors, right, you have the summary, the investor deck. You know, I wouldn't include any investment terms on that thing, just because you don't want to make it like that's a generally soliciting the offering or sale of securities for the reasons I mentioned. But just a summary preview of the business, which then would just get people interested to learn more about the deal. Then you enter into an NDA, basically, so you're comfortable disclosing information, financials, legal, just information about the company to a potential investor. So while they kind of evaluate whether or not they want to go, you know, invest in the company or not, then, you know, you might get to a term sheet where, you know, you kind of talk high level about, okay, how about this much for this amount, or a board seat, or you start talking about major deal points prior to getting to the investment documents, just because, you know, it shows commitment to the deal. You know, you're not getting all the way to the investment doc and then finding out there's a deal breaker and having to kill everything after investing a lot of time and effort into it. So term sheet is good, just even though it's non-binding, get everybody on the same page. Valuation, you know, it's you know, outside the scope here, but something to look at. That's always subjective. So it's something to keep in mind there. And then getting to the investment documents, I think is the last thing there. But yeah, that's kind of it. I know we kind of went past the time, a lot of information there, but you know, there's written materials for everyone to read, and I got some sample agreements for you guys that have some comments and notes. So feel free to check those out.
Thank you, Daniel. Kat, I don't know if you have questions teed up. I have some, and but maybe you've gotten some directly. So do you want to kick? Oh, you're on mute.
Yeah, sorry. Actually, today all of them were in the chat box.
Okay. All right. Well, if I miss it, let me just kind of go down some things, and of course, if I miss it, I'm sure you'll tell me. The first question, and the questioners, please let me know if I've misstated your question or don't capture it. Question, and we'll do this like a lightning round, Daniel. So, you know, we want to get through it.
Yeah.
So the question is, one questioner attendee asked, isn't it dangerous to give up more than 51%? So that's a control issue. And then his second question was, are there any programs, or her question, are there any programs for minorities or women-owned businesses that could help on the fundraising side? So those are 2 questions raised. Can you address the control question first?
Yeah, definitely. I mean, I think your hunch is right. I mean, if you give up 51%, that's, you know, a significant event, because of the default rule for a lot of these companies, you know, are majority vote at the shareholder level of a lot of kind of fundamental things. And as you know, for a corporation, shareholders elect the directors appoint the officers, right? So if you have 51% of the shares and it's a typical corporation, then really you can put into place the directors, and then the directors can then put into place the officers. So you're essentially in control of the company. My I think comment there is that, you know, if you're exiting the company, if you've built it up and you're getting a good price for that 51%, you know, then maybe that's, you know, something that you're willing to do, because a lot of times maybe an investor of that caliber, you know, would not want to come in for anything less. So I think it just depends on the circumstances, depends on the deal, but in general, yeah, I mean, 51% is a significant amount for basically the giving up control.
Yeah, I think that if I could add that if I come across entrepreneurs that are focused on maintaining 51%, I worry about them, frankly, because I like to help people that have the mindset of doing the best for the entire company and everybody. And that sometimes could, like Daniel said, means you have to give up control. And if they're fixated on control, you're probably going to scare away investors, because they will think that you're hard to work with and focused on the wrong thing. So it kind of depends, you know. I mean, certainly small businesses, you know, you'll maintain control. But if you start fundraising, it's sort of dangerous to draw the line there. The second question they raised was, are you aware of any programs, Daniel, for women or minorities that could assist them in this funding process?
Yeah, I'm not an expert at that, but I do know of, I think the SBA has, I think, a lot of programs for both the minority and women-owned businesses, and I think for both of those basically, and I think that would be the best place to go, is just to check out the local SBA office. I think that'd be the good thing, and also that's on the, I guess, the loan government grant side. On the equity side, there might be certain accelerators or venture funds, out there that are, looking for portfolio companies with that kind of demographic. So I think that's just kind of more looking around and finding, seeing if there are investor groups like that, I think.
Okay, good. One question was, if they apply for an RFP to the city and county of Honolulu, does that fall into any kind of financing category?
Yeah, I think financing, I mean, it's broadly just, getting money for your company. So I think the RFP, if it's for a grant, then, I think that would, just be, like really you're applying for a grant. But if it's RFP for, a contract or a job, then, I'd say no, that's, more obviously a services contract or business or relationship. But yeah, so I think it would qualify as financing, getting money, but I don't know if that would really be significant for anything else. If they're, I guess if they're thinking like there are certain restrictive covenants or restrictions on going out and getting funding or financing, if it falls within some sort of defined term financing, I think it depends on the context.
Usually it's for something they want to buy. So you're usually selling the city something or the government entity. But if it's a grant, it's free money, which is great for everybody.
Right.
Everyone likes free money. One question had to do with units, and the question was, how many units can I issue? And the attendee rightfully pointed out that they might need to amend their operating agreement. So you want to kind of discuss like in an LLC context, how would you fundraise? What are these units?
Yeah, so like I said earlier, I mean, LLCs are creatures of contract, so you can have it based on just percentage, right? 100%, and people have percentage interest in the LLC, or like this person said, he or she has units. So similar to stock, right, where there's probably a total amount of units, and then based on the amount of units that are issued, that's the percent of the company and that they have for taxes and all that. But I think it sounds like in the operating agreement, if there is a cap on the units, right? If it says the company can only issue, 1,000 units, and there are already 1,000 units out there, then right, the operating agreement would have to be amended to increase the amount of authorized units. If it just says the company can issue units from time to time at the discretion of the manager or the members vote, then you may not need to plug in a hard kind of cap on that. It's just the process of authorizing and approving more issued units, whether the manager can do that on its own or it requires member vote. And I think just strategy there is, if you're raising money from other investors, you want to think about that, right? Maybe you don't want to authorize more than you need for that one offering, because you wouldn't want, let's say if that investor had some sort of control where they could issue more of those available authorized units without your consent. But now if they're at the already the authorized cap, they would need all the members to vote to increase that amount under the operating agreement. So that'd be advantageous, I think, to someone that's maybe trying to not be diluted down the road. So I think that kind of you want to think about.
Yeah. I think that's beyond this person. I think that she doesn't have any units right now authorized.
Well,
so anyway, the answer is yes, you need to amend your operating agreement. We posted some forms on our website, which I put in the chat, where you can download. Of course, you're getting into some complexity here, and so you could just do it yourself. But at least if you put some homework in, hopefully your legal fees would be cheaper, because hiring lawyers to do this will be thousands of dollars of time if they charge their normal rates. So hopefully we can give you a head start there.
Hey, Greg, one more comment about that. So if she's trying to raise capital and she doesn't have units, I think, you can still do that when it's just in a percentage. I mean, I didn't want to say that you only could do that if it's units. So you could also just, like I have a form that will be provided to you. If you own 100% of the LLC right now, let's say, that form will can document you selling amount of like 20%, 25%, 10% of your 100% to an investor. But now that there's going to be multiple members in the LLC, you kind of want to take a look at that operating agreement now that it's not just one person. There's going to be member right type stuff that comes into play.
The normal case is owners in LLC have a percentage, but the beauty of LLCs is you can do pretty much anything you want. It's very flexible. And so when we create units, we're trying to approximate how a corporation behaves with shares. And the beauty is when you issue someone units in an LLC, you don't have to calculate the percentage. You just say, here's 100,000 units, and then they can do the math. They can see how many other units there are, and they do the math, and the percentages automatically change when you issue units, like they change in a corporation when you issue shares. So it's very efficient to have units when you're fundraising or bringing in other owners. Percentages are good when you have an initial group and you're not going to change it. Because every time you bring in someone, say you give them 5%, now you got to restate everyone else's percentage, right? It's not automatic. And so either way works. But I think if you're fundraising, units are a good tool. I think we have another question here about NDAs. Should they use an NDA in crowdsourcing?
No, I mean, I think because I don't know, I'll qualify by saying I don't know everything about crowdsourcing, but from my understanding, you go through the platform where you don't really need to disclose any confidential information. I think you just say, here's the campaign, here's the gift, and then that's pretty much it. But I think the answer probably depends on what exactly you need to disclose. I think if you're talking about crowdfunding and crowd lending instead, where you're actually going through the platform and investors can buy like small amounts of equity in your company, then that's different. I think the NDA would be probably with the platform itself, the broker dealer that's like the WeFunder or whatever that's leading the platform. You would probably have one with them, and then they would have something on their end with every investor that comes in, possibly. But that's something to look into. But if it's just the crowdsourcing like Kickstarter and that, based on my understanding of how those things operate, I don't think you need one because you're not really disclosing anything confidential.
Yeah, I think it was crowdfunding, but I think they must have a process, because this can't be the first time this question's been raised on those sites. So right. I'm pretty sure they would have an ability for you to keep information confidential. We're sort of hit 11 o'clock. And so if I could just throw out a few things that occurred to me. The biggest challenge for small business raising money is the fact that the investor doesn't know when they're going to get repaid. There's no IPO, initial public offering, on the horizon, because a small business can't go public like an LLC. You could sell your business, but that's not within the entrepreneur's control. And so do you have any advice for small business owners, Daniel, about what kind of terms should they offer to an investor to entice them to invest in a situation where the exit is unclear?
You mean in an equity financing situation?
Yeah, in issuing units.
Yeah. Maybe you could agree to have some sort of periodic distributions of available cash. Right? Like I think that's similar to how an investment or a promissory note or loan would be, where the company has to make periodic payments. So an investor is not just waiting on that big capital exit event, right? I mean, they may get some maybe annual distributions of available cash, and then the company just, you define that term really broadly, where the company can have reserves for working capital and all that, where and maybe kind of or maybe you kind of really can kind of put in parameters on how much you're really agreeing to do, but that's one way to kind of offer some cash flow to investors. Or, royalty financings are big these days too, I think, where they're investing in more of a revenue stream based on, net revenue or gross revenue, or a sale of particular units, maybe a percentage of that. But so I think that brings up a good point. To attract investors, I mean, you want to do what's favorable for the company and work down from there, right? What's most favorable is doing a SAFE, I think, right? Is where it's really, the future equity really you're giving up, but you don't have the debt component of that, and you're not giving up any ownership off the bat. But investors don't really like that, so then you have to kind of work your way down through all the options.
Right. I mean, I think for small business, it's going to be a cash flow deal, probably of some kind, because that's what you have to offer. But I want to thank Daniel for this great webinar. We've recorded it, and so we will eventually post it. And Daniel agreed to stick around for a few more minutes in case anyone has any follow-up questions. I want to thank our interns, Stefanos and Christian, for helping us put the flyers together. They're students at the University of Hawaii School of Law, and appreciate all of their help. And my colleague, Kat Tashner, for being willing to work with me all these years and put this on. And so hopefully we'll see you next week at our next webinar. Otherwise, have a beautiful day and a great rest of your week. And feel free to reach out to us if you have any questions afterwards as well. Okay? Thanks, everybody.
Thank you.
Thank you.
Hey, Daniel, I got a quick question for you.
Yeah.
Okay, so I've been talking to a few investors, and one thing that I always tend to get asked is a question on ROI. So when I'm trying to raise funds based off of equity, and I'm hoping to IPO at a certain point in the future, and they're asking me about ROI, are they referring to getting some type of cash flow in return? So what was the term that we used? Residual financing or something like that?
I'm not too sure about that. I mean, Greg might have some thoughts on that, but I think, there's
royalty financing. Sorry. Yeah.
Sorry, was that royalty financing?
Yeah, royalty. Is that what they're asking about when they're asking about ROI? Because that's always popping up.
Yeah, no, I mean, I think generally they're probably just kind of calculating in their head. There's basically what's the return on their investment, right? There's all these different formulas you can use for that. Some people use, I think, a common one is just the cash on cash, right? Because that's the easiest to understand. How much cash is going in? How much cash am I expected to kind of get back out? But I mean, it's not that simple. A lot of times they're not doing the cash on cash ROI calculations. So honestly, I'm not, that's not the area that I specialize in. So I think you got to talk to basically your financial guys about that, or what they're expecting. But on the securities law side, I think just you want to be careful, basically to tell them anything there on here's what you're going to get, right? I think you want to use maybe past historical examples, or kind of use a lot of assumptions and forward-looking statements and language, on that. But I think that's kind of where you can kind of back yourself into, securities laws issues if you promise an ROI and then they don't hit that.
Yeah.
I think investors want to know how much money they're going to make.
Yeah.
They don't care about your product or service. You care a lot about it, and that's one mistake entrepreneurs make, is they spend too much time talking about how great their product is. Well, investors don't care. They care if they make a lot of money, then they care that it's a good product, but beyond that, they don't really care. So what they care about is money. And so I think that you want to surround it with disclaimers, of course, but if you give them different scenarios, like you could have, you could have 3 different scenarios you could give them. Everything goes well, couldn't ask for anything better. This is what it looks like. Medium case, well, maybe here's, we hit a double or something. It's because things always go wrong, right? I mean, no matter what you do. And then here's a case where we're not going to do that well, and here's a case where we fail and you get nothing, so you got to give them the full gamut of outcomes. But the point is, you should be proactive, because if they ask you that question, then that's a problem. You didn't pass the test. So that should be the main takeaway, is you want to give them information so that they don't ask you that sort of question, because that means you didn't tell them. And
yes, so
one of
that's
the
what I'm trying to understand though, is that like for the ROI, if it's like, are they hoping to, like, when the company IPOs, that's when they're going to be getting their ROI?
Yes. So if you're a high growth company, I have a spreadsheet that VCs use. They put in all of the data that the entrepreneur gives them. And at the end of the day, they calculate their multiple on investment. They think more in terms of making 4x, 5x, 10x their investment, within 5 years, let's say. And so this one particular venture fund plugs all the numbers in, and I can't remember the multiple. Let's just say if you don't even make 4x based on everything you've said, then they pass. So if you don't know that, then you're behind. You're already behind. Yeah. You should be doing the exact same calculations, because if everything you tell them means that they walk, then why even have the meeting?
Yeah.
And secondly, maybe you can re-engineer your business model so that you can possibly achieve the returns they want. Of course, you don't want to lie or promise something you can't do. That's not the point. But you have to do your homework, and you kind of reverse engineer from your IPO to today and show them that you can make the multiple that they want. And if not, then you have to go back to the drawing board, Yeah. So I think that's what, experienced entrepreneurs will do in Silicon Valley. They will know exactly what the audience wants and needs. So even before it's asked, they've got all the numbers crunched already. So the VC says, well, what's your multiple on return at IPO? Oh, let me pull up my spreadsheet. And they say, oh, here's the numbers. This is what it looks like. Of course, we don't know that this is going to happen. It might all, fail, might, crash and burn. But if all goes well, then this is a possible scenario, right? Yeah. So, and if you want, I can send you that spreadsheet if you email me. And those are sort of like the trade secrets of the VCs, how they operate. But this one fund is a Hawaii friendly fund, and so they were willing to share how they operate. But I've talked to Dustin Shindo was the last IPO in Hawaii, Hoku Scientific. Even Darren Kimura of Sopoji, they don't necessarily do that. What they'll do is they'll go to a company they want to emulate, and they'll reverse engineer their entire financing to the startup. You got to be willing to put in that kind of time to understand what do you need to do to go public. So you can see the actual numbers based on SEC filings of what they did. And you can actually calculate the ratios and the multiples and see, right? Do you measure up to what they're doing? So, and actually, I think they'd be available to entrepreneurs here because they're very focused on Hawaii and want to help entrepreneurs, especially, I don't know if you're a UH person, but, they like helping Hawaii people. So, if anyone's interested in that sort of thing, I can reach out to them to see if they're willing to help. I know Dustin lives in Hawaii now. I don't know if Darren's in Hawaii, but I know Dustin has helped some entrepreneurs that I sent his way. So we have a small ecosystem, so you got to use the people that have actually done it, and there aren't that many. So.
Greg, I just put my email in the chat. Would that suffice?
If you guys could do me a favor and email me directly so that because this chat is not going to be preserved. So if you could email me at gkim at vantagecouncil.com, VAN, or I'll put it in the chat. That's my business email. So, and I'm happy to. Yeah, because entrepreneurship is not a crapshoot. It's not like you just chance them. It's smart risk taking. And I think that's the education of an entrepreneur, right? To do the homework. Of course, if you've never gone through it, you won't know it. So the first time through is investors like it when you fail because that means the next time they'll invest in you because you've already taken your lumps. So they don't want you to fail on them, of course. But anything else from the gallery? If not, then we will adjourn the session. And I guess for this panel, for the planning team and Daniel, we can stand for a few minutes to kind of wrap up, but everyone else can be excused. Thank you.
Thanks.